It kind of also makes it so we're going to have a bigger account size for this, but let's try it out. Let's see what happens. We can play around with this a little bit. This research is still coming back here. Then please use 5% of the account to buy a put spread that is described like this below. And this is still doing it. You might have to sell some of the TQQQ in order to buy the put spread. Right? So basically, we're going to have 90% of our money inside of TQQQ on a regular basis, but only if it's above the 200-day moving average. And then we're going to take 5% of the account and buy this put spread so we actually make money on the way down. I think that's going to be really interesting. So we own TQQQ only for above the 200-day moving average. And then we use that with, we do that with the 200-day, yeah, we do 90, okay, so we use 90% of the account to buy TQQQ, but only if it's above the 200-day moving average. And then we're going to take 5% of our account and we're going to put it into a put spread that's going to be rolling on a regular basis. So that will make us money. So TQQQ should make us a lot of money when the stock market's going up. By the bet, like it's an incredible ETF. I don't know if you guys have ever seen TQQQ. This is why I love this thing. By the way, TQQQ is incredible. If you look over a long time period, it's up 24,000% since it started. That's crazy. Like this is like getting into like Nvidia or Amazon territory, and you don't have to pick the stock, right? You just pick the whole index, right? The problem with TQQQ is that it does get hit pretty hard in downturns. So when things fall, it does get hit pretty hard. That's why we do this 200-day moving average. That protects you against a lot of that, right? Or at least historically has protected against something like that. Again, not financial advice here. But if we own TQQQ, we can make a lot of money on the way up. And then if we hit below the 200-day moving average, we exit so that we prevent big losses with that. And then on top of that, now we're going to own this put spread that could potentially even make us money on the way down, which I think is pretty damn interesting. Okay. Now let's take a look at what the research came up with here. It did a lot of research for us. Okay. There isn't a single best put spread that dominates over 10 to 30 years, but the research does give us some pretty clear guidance on maturity, delta, and how often to roll. Okay, what the research says versus vibes. Studies on options, overlay, and tail hedging. A big 2020 Monash paper looked at a huge grid. Okay, key findings that matter to you when buying puts outright for downside protection. Longer maturities, over 6 months, up to a year, had better risk-adjusted performance than short-dated stuff. Really interesting. Okay, so we probably want to have longer dated puts. That actually kind of makes it a little bit easier because we don't have to trade so often. I actually like that idea. Best results were at the money or slightly out of the money puts, 85 to 100% of spot, so 0 to 15% out of the money. When they tried to cheapen the hedge using put spreads or put ratios, those underperformed simply buying the put on their main. Okay, so it actually says that they just bought puts. They did not buy spreads. But within the spread family, shorter put maturities did better than long ones. For pure hedging, long dated, near at the money single puts were best. Okay. If you insist on spreads, the better ones are around. Okay. Classic 1 month hedge, your instinct. Okay, buy protection. It's simple, but historically expensive. Okay, so maybe we just buy puts. Maybe we don't buy the spreads. That's what it seems like. That's actually a lot simpler as well. Okay, so let's see where to take this next. Define the choices. Okay, so what is your recommendation? What should I be doing? What do you think is the best option for me? I think we should be buying puts with a 1 year maturity. Okay, here's the clearest. Okay, they want to profit the most research supported structure. A 60 to 90 day slightly out of the money vertical put spread rolled monthly. What are you talking about? I thought you just told me that owning single puts and not the spread was the best thing. Why are you now all of a sudden advocating for puts spreads again? And I thought you said it should be 6 months to a year expiration. So why are you all of a sudden saying 60 to 90 days? I don't understand why you're going against what you told me the research was. So what do you think about that? Put it into the comments. Let me know. I respond to all of your comments. So I'm very interested to hear what you thought about the video and what do you want to see next. And of course, if you're interested in any of this stuff, go check it out at botspot.trade.